A guy walks into a Vanguard office in 2003 with $1,200 a year. He's been putting into an index fund since he was 22. He's now 65. The account shows $1.2 million. He never picked a stock. He never timed the market. He just clicked auto invest and forgot about it for 43 years. Meanwhile, his college roommate, who made twice as much money, spent the same 43 years chasing hot stocks, reading investment newsletters, panic selling during crashes, and ended up with $70,000 and a bunch of opinions about the Federal Reserve. The difference wasn't intelligence. It wasn't income. It was one brain understanding compound interest and the other brain treating investing like a hobby. Here's what nobody wants to hear. Most people will never be rich, not because they don't earn enough, but because they don't automate the one behavior that actually builds wealth. They think they need a plan. They actually just need a monthly transfer that happens whether they remember it or not. I'm going to explain why $100 a month, invested consistently over decades, will mathematically destroy almost any other financial strategy you're currently excited about. And why the people telling you otherwise are usually selling something that benefits them more than you. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. The mental model I want you to hold is this. Think of wealth building like filling a bathtub. Most people focus on the faucet, trying to increase the flow of water coming in. Get a raise. Start a side hustle. Hustle harder. That's fine. But here's the thing. If the drain is wide open, it doesn't matter how much water you're pouring in. The tub never fills. The drain is your spending. The faucet is your income. But here's what almost nobody talks about. There's a third element. It's called the overflow pipe. Once your bathtub reaches a certain level, water starts flowing into a separate system that works completely differently. That overflow pipe is invested capital. And that system, it fills itself. You're not adding water anymore. The water is multiplying. This is compound growth. The entire financial services industry spends billions convincing you the faucet is the only thing that matters. Because if you're obsessed with earning more, they can sell you courses, coaching, credit cards, car loans, and lifestyle inflation. But if you figure out the overflow pipe, you stop needing them. And that's exactly what $100 a month is. It's you deciding to route a tiny percentage of your income away from the consumption drain and into the compounding overflow before you even see it. Here's where people mess this up. They hear $100 and immediately think it's not enough to matter. Let me fix that belief with actual math. $100 a month invested at an average annual return of 8%, which is below the historical average of the S&P 500, turns into approximately $150,000 after 30 years. You personally contributed $36,000. The market contributed $114,000. That's a 3x return on money you probably spend on stuff you don't remember buying. Now let's stretch it. 40 years. That same $100 monthly becomes $350,000. You contributed $48,000. The market contributed $302,000. You're not rich because you earned a ton. You're rich because you let time do the heavy lifting. Now, you might be thinking, okay, but I'm not 25. I don't have 40 years. Fair. Let's say you're 40. You've got 25 years until traditional retirement. $100 a month at 8% becomes $95,000. Still triple your contribution. And here's the kicker. Most people in their 40s are earning more than they were in their 20s. If you can increase that monthly amount even slightly, the numbers get absurd fast. $200 a month over 25 years is $190,000. $300 a month is $285,000. The system scales, but only if you start. But now you might think, what's 8%? And why should I believe that's realistic? Let me explain what's actually happening under the hood, because this is where most personal finance content lies to you by omission. When I say 8%, I'm talking about the average annualized return of a boring, low-cost index fund tracking the S&P 500 over the last 50 years. Some years, it's up 30%. Some years, it's down 18%. The average shakes out around 10% before inflation. After inflation, call it 7 to 8. I'm not talking about picking stocks. I'm not talking about crypto. I'm not talking about real estate unless you're ready to deal with tenants and toilets. I'm talking about owning a tiny slice of the 500 largest companies in America and doing absolutely nothing else. Apple, Microsoft, Nvidia, Google, Amazon, you own all of them. You don't have to research them. You don't have to watch CNBC. You just own the entire machine. This is where systems thinking destroys individual effort. The average person cannot beat the market. And I mean that literally. Morningstar data shows that over 15-year periods, around 90% of actively managed funds underperform their benchmark index after fees. The people with finance degrees and Bloomberg terminals lose to the index. And you think you're going to outperform by reading Reddit threads? This is where it gets really interesting. The psychological shift required to make this work is not about becoming smarter. It's about becoming more boring. Wealth is built by people who automate behavior and then ignore it. I've spent 10 years running my own business, surrounded by accountants and fiscal lawyers who manage money for people worth 8 and 9 figures. You know what those people are not doing? They're not day trading. They're not chasing meme stocks. They're not checking their accounts every week. They set up automatic transfers into index funds and then they go live their lives. The obsession with active management is a cultural sickness sold to you by brokerages that make money on commissions. The more you trade, the richer they get. The less you trade, the richer you get. Incentives explain everything. Here's a parable. 2 brothers inherit $50,000 each. Brother 1 thinks he's smart. He opens a brokerage account, starts reading Seeking Alpha, buys individual stocks, gets excited during bull runs, panics during corrections, sells low, buys back high, pays short-term capital gains taxes on every trade. And after 10 years, he's got $65,000. He spent hundreds of hours researching. He felt like an investor. He got a 13% total return over a decade. Brother 2 thinks he's lazy. He dumps the $50,000 into a Vanguard S&P 500 index fund, sets up auto investing for $200 a month, forgets his password, and checks the account once a year out of boredom. After 10 years, he's got $120,000, a 75% return, and he spent maybe 3 total hours thinking about it. Same starting capital, wildly different outcomes. The difference was ego. Brother 1 needed to feel smart. Brother 2 just needed to be patient. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Let me show you a real case study with actual numbers because I know some of you are still skeptical. Let's invent a person. Call him Mark. Mark is 35, makes $75,000 a year, has $18,000 in credit card debt, drives a car with a $400 monthly payment, and rents an apartment for $1,600 a month. Standard American financial situation. Not ideal, but not catastrophic. Mark hears about this $100 a month idea and thinks it's impossible. He's barely breaking even as it is. So let's do the forensic accounting that most people refuse to do on themselves. $75,000 a year is about $4,800 a month, after taxes in a state like Texas with no income tax. Rent is $1,600. Car is $400. Insurance, gas, phone, utilities. Let's call that $600. Minimum credit card payments at $18,000 of debt, probably $300 a month. We're at $2,900 in fixed costs. That leaves $1,900 a month for food, entertainment, random purchases, and emergencies. This is where people lie to themselves. They think they're broke, but what's actually happening is lifestyle spending absorbs every available dollar. Mark doesn't have a math problem. He has a priority problem. If Mark cancels 2 streaming services he doesn't watch, stops ordering delivery 3 times a week, and skips 1 discretionary purchase per month, he's found the $100. It was always there. It was just allocated to instant gratification instead of future compounding. Now, here's where it gets even better. Mark sets up that $100 auto transfer. 6 months later, he doesn't even notice it's gone. His lifestyle adjusted. Parkinson's law of spending. Expenses expand to fill available income. So if you remove income before you see it, expenses contract to fit what's left. A year in, Mark gets a 3% raise. That's about $200 a month after tax. Old Mark would have let that dissolve into slightly nicer dinners and an upgraded phone. New Mark increases his auto investment to $250 a month. His lifestyle stays identical, but his overflow pipe just doubled. By the time Mark is 55, assuming he keeps this up and adjusts for income growth, he's sitting on $400,000 in investments. He's not retiring to Monaco, but he's also not terrified of getting laid off. That's the difference. Now, let me hit you with the thing that nobody wants to say out loud. The reason most people don't do this is not because they can't find $100. It's because saving feels like losing. Spending feels like winning. Your brain is wired for immediate feedback. You buy something, you get a dopamine hit right now. You invest something, you get nothing right now. In fact, for the first few years, you get the psychological punishment of watching your account grow painfully, slowly, while your friends are posting vacation photos funded by credit cards they'll still be paying off in 5 years. This is why behavior beats knowledge. Everyone knows they should invest. Almost nobody does it consistently. The gap between knowing and doing is where most wealth is lost. I've been investing for over a decade. I have multiple hundreds of thousands of dollars in the market. I'm telling you this not to flex, but to tell you that the money doesn't make me smarter. It makes me more aware of how dumb I used to be. I wasted years thinking I needed to learn more before I started. That was just fear disguised as diligence. The actual skill is starting before you feel ready and automating it so you can't self-sabotage. Here's another psychological trap. People wait for the perfect moment. They say, I'll start investing when I pay off my debt, or when I get a raise, or when the market stops being volatile. Guess what? There's never a perfect moment. Debt payoff is important, sure, but if you're only paying minimums anyway, investing $100 a month in parallel won't kill you, and the compound clock is already ticking. Waiting for the market to stabilize is insane because the market is always volatile. That's what makes it a market. The crashes are features, not bugs. In fact, the people who build the most wealth are the ones who keep investing through crashes because they're buying assets on sale. Everyone wants to buy low and sell high. But when the market is actually low, they panic and do the opposite. If you automate, you remove the emotional decision entirely. You buy high, you buy low, you buy medium. Over 30 years, it all averages out and you win. Now, I want to address the people who are sitting there thinking, I don't trust the stock market. I get it. The 2008 financial crisis scared an entire generation. But here's the data you're ignoring. If you had invested $10,000 in an S&P 500 index fund in January of 2008, right before the crash, and did absolutely nothing, by 2020, your account would be worth about $37,000. You lived through the worst financial crisis since the Great Depression, and you still almost quadrupled your money in 12 years. People who panic sold in 2009 locked in their losses and never recovered. People who stayed in or kept buying became wealthy. This isn't speculation. This is historical record. The market rewards patience and punishes emotion. Let me give you another angle on why this works, that most finance gurus won't tell you because it's too boring to monetize. The $100 monthly habit is not about the money. It's about identity. When you automate an investment, you're voting on the type of person you're becoming. Most people's financial identity is consumer. They see money as something to spend. The goal is to upgrade that identity to investor, someone who sees money as a tool for building systems that generate more money. That shift is subtle, but it changes every other financial decision you make. Investors don't buy new cars. They buy used cars and invest the difference. Investors don't finance furniture. They sit on cheap furniture longer and invest the payments they didn't make. This isn't about being cheap. It's about playing a different game than everyone around you. Most people are playing the status game. Investors are playing the time freedom game. Different scoreboard, different strategies. Here's a quick cutaway, because I know what some of you are thinking. But Tom, what if I want to enjoy my life? You can. This is not about eating ramen for 40 years. This is about not confusing spending with enjoying. The highest satisfaction moments in most people's lives are free or cheap. Time with family, walks, conversations, experiences with friends. The stuff people finance, cars, clothes, gadgets, delivers diminishing returns on happiness almost immediately. Hedonic adaptation is real. You get used to the new thing in 3 months, and then you need another hit. Investing delays gratification, but it also builds the foundation for actual freedom later. Would you rather fake flex now and stress about money forever, or live modestly now and have options at 50. Here's the third practical thing nobody tells you. The $100 habit makes you better at earning. Sounds backward, but it's true. When you're investing, you start thinking in terms of leverage. You look at your time differently. You start asking, how do I earn more per hour? That leads to skill development, negotiation, side income, freelancing, or just doing your current job better so you're the obvious promotion choice. The scarcity mindset, where you feel broke all the time, makes you desperate and bad at decision making. The abundance mindset, which starts when you see an investment account growing every month, makes you confident and better at recognizing opportunities. I've watched this play out in my own business and with friends who finally started investing. The mental shift is real, and it compounds just like the money does. Now, let me tell you where this whole system breaks. There are two failure modes. The first is you start, you see it growing slowly, you get bored, and you cash out to buy something stupid. I've seen this dozens of times. Someone builds up $8,000 over 2 years, then drains it for a vacation or a down payment on a car they can't afford. They just rob future them to give present them a dopamine hit. Don't do this. The second failure mode is panic selling during a correction. The market drops 20%, you freak out, you sell everything, and you lock in your losses. Then the market recovers, and you're sitting on the sidelines in cash watching everyone else get rich. This is why automation matters. If you never log in, you can't panic sell. Out of sight, out of mind, compounding in silence. Let me zoom out for a second and talk about what this really is. Investing $100 a month is not some genius hack. It's the financial equivalent of brushing your teeth. Boring, obvious, unglamorous, and absolutely critical. You don't brush your teeth once and expect them to stay clean forever. You do it twice a day for your entire life because the alternative is painful and expensive. Same with investing. You don't invest once and retire. You invest consistently because the alternative is working until you die, or depending on Social Security, which pays an average of about $1,600 a month. Good luck living on that. The system is not designed to take care of you. It's designed to extract from you. Your job is to quietly build a parallel system that works in your favor. Here's the part where I bring it back to incentives, because this is the lens that explains everything. Why does every bank want you to open a high-yield savings account, but not a brokerage account? Because savings accounts pay you 1% while they lend your money out at 7% and pocket the difference. Why does every car dealership offer financing? Because they make more on the loan than the car. Why does every financial advisor want to manage your money for a 1% annual fee? Because 1% of your portfolio every year for 30 years is 30% of your money going to someone who statistically won't beat the index. The entire economy is built on the assumption that you will consume now and pay later. Investing $100 a month is you opting out of that game. You're saying, I'm going to pay myself first and let the system work for me instead of against me. That's why it feels uncomfortable. You're swimming upstream. Lazy investing built more fortune than crypto memes. I say that because I've seen the data and I've lived it. The people I know who got rich slowly are all still rich. The people I know who try to get rich quickly are all back at their day jobs, still posting about the next big thing. Slow is smooth. Smooth is fast. Compounding is boring until it's not. And by the time it's not boring, you've already won. So here are your 3 takeaways. First, automate $100 a month into a low-cost S&P 500 index fund starting today. Not Monday, not next month, today. Because every month you delay costs you years of compound growth on the back end. Second, never log in except once a year. Because the more you look at it, the more likely you are to do something stupid like panic sell or try to time the market. Third, increase your contribution every time your income increases, even by $50. Because lifestyle inflation is the enemy, and investing the raises is how you retire a decade early. That's it. No complexity, no stock picking, no gurus, just automated behavior repeated until you're financially free. The market doesn't care about your feelings. It cares about your consistency. Be boring, get rich.